Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, August 19th, 2022. Starting with markets, we got stock down in the OPEX this morning, commodities mixed, crypto down big, dollar up, global bond yields up, both of those up big as well. Market moving headlines here, so still no official dovish pivot, while two voting members of the FOMC, St. Louis Fed head Jim Bullard and Kansas City Fed head Esther George, diverged yesterday on the size of the September move. 75 bips for Bullard, 50 bips for George. They reiterated the need to hike rates to quell inflation in comments yesterday. Non-voting officials also reiterated the Fed's hawkish stance. Yet San Francisco Fed Mary Daly said officials will be in no hurry to reverse course next year, pushing back against bets for rate cuts before the end of 2023. Recall that the Eurodollar futures curve and other money market curves like OIS and Fed Fund futures are inverted for next year because the market thinks the Fed's going to do a quick about face and turn and pivot. So now you're getting a lot of Fed heads pushing back. We may be at the beginning of a new phase of the monetary policy dance. The first phase was, the Fed catching up to where the market had been on persistency of inflation and having to get tight. The second dance is the market saying, okay, we're at peak hawkishness, and the Fed having to catch up to the market. And now we might be back in a phase where Fed heads are leading the market to a place that is more hawkish relative to what is now currently priced in to, again, money market rates, and obviously as a function of that, broader asset classes. He also had Minneapolis Fed Neil Kashkari said we have an inflation problem right now, and the central bank has to get it down urgently. And I thought the word urgently was pretty telling in the sense that this is a Fed that may not lean on the sort of transitory narrative and just try to give itself some time for inflation to get under control. They might still have a sense of urgency, particularly as we go into the fall and early part of the winter in terms of removing accommodation from the economy and financial markets. I wouldn't say this is new, but it's certainly new relative to where markets have begun to price themselves in terms of the panacea of Goldilocks economically and from the perspective of monetary policy. So we'll get more clues on this at Jackson Hole, which we'll preview now. Investors are now focused on the Fed's annual symposium at Jackson Hole, Wyoming. That's next Thursday through Saturday for further clues on the policy path. Next Friday, we received the July update for core PCE, the Fed's preferred inflation gauge, and the August final reading for the University of Michigan's 5 to 10 year forward inflation expectation survey, which Powell called out at the June FOMC as one of those key barometers they're looking at to determine whether or not long-term inflation expectations are quote unquote unmoored per Governor Bullard. While an upside surprise for either of those indicators is unlikely given the breakdown we saw in their leading indicators. We have trim mean CPI, median CPI, and sticky CPI all breakdown, gasoline prices, which tend to drive both short-term and long-term consumer inflation expectations. All those things have broken down, so it's unlikely we get an upside surprise next Friday, but it still could happen. And if it happens right in the middle of the Jackson Hole Symposium, we're going to have a problem on our hands with respect to asset markets. So the balance of risk is certainly still skewed to the downside with respect to markets relative to our base case scenario and our bear case scenario from a net liquidity perspective. Anyway, in recent weeks, we've obviously observed all these ancillary Fed heads pushing back on dovish pivot speculation. Will the powers that be, Jay Powell, Vice Chair Lyle Brainerd, be forced to, by the data, to join this sort of hawkish chorus of Fed heads that we've heard from in recent weeks? Perhaps that's what's being priced into the currency and bond markets today, and may potentially be priced into them over the course of the next several weeks. Anyway, big movers this morning. We got Bitcoin down 8% to off 8% month over month. Ethereum down 10% to plus 9% month over month. We talked about that yesterday. If we started to see Ethereum underperform Bitcoin, this is a sign that the liquidity function in the asset markets and the global and just general risk appetite are really starting to move in the other direction, a direction that favors both our base case and bear case scenarios as opposed to our bull case scenario, which we would argue is somewhere around S&P 4400. And then lastly, 10-year Treasury yield up 10 basis points today on this hawkish commentary to 2.98%. It's down 1 basis point month over month. The one thing I would call out is that we're still seeing duration risk in the curve as a function of Fed policy rate speculation. And so that tells you that the Fed has got, I wouldn't say complete control of the curve, but the whole curve is really eyeing the Fed for clues as to the monetary policy speculation, because again, we have a series of rate cuts priced into money markets starting the spring of next year. So maybe that gets priced out in the coming weeks, and that's something that will not be good for asset markets. Anyway, US dollar, it's great for the dollar, by the way. Bullish VAMs It's getting close to the upper boundary of its probable range. You got 0.4% upside, minus 2% downside. Gold bearish FAM's getting close to the lower boundary of its probable range, 1.5% of downside versus 2.6% of upside. 10-year nominal treasury yield neutral VAMs got about 10 basis points of upside, 40 basis points of downside. I'd like to see how this thing trades through. We could start to push through. I'm not sure if we'll see higher highs unless that Corp BC report really surprises to the upside. But certainly it's definitely one of the key indicators to watch, if not every day, certainly every day. Bullish high yield credit spreads bouncing off the lower boundary of the probable range. You got 22 basis points of downside, 40 basis points of upside. S&P 500, that is bullish FAMs. Finally getting a little pullback from the upper boundary of its probable range. It's been a very relentless chase, both in terms of short covering by CTAs and quants, but also by some, sort of bears throwing in the towel one by one over the last few weeks, and appropriately so to some degree. You shouldn't be as bearish today as you were, let's call it June 30th, just as a function of the data we got. We got our earnings better than expected. The PMI is better than expected and accelerating. Jobs, gangbusters. We got inflation breaking down at a rate that we've historically been unprecedented if you look at the core inflation momentum. So a lot has changed since June 30th in the direction of favoring Goldilocks economically, and that's why the market, fundamentally speaking at least, that's why the market is up at 40-some thousand or 4,000 plus as opposed to 3,600. But again, as I just talked about, we might actually have to go through another phase of monetary tightening again. So let's hold our horses here. But anyway, right around the middle of the range, about 2% downside, 2.5% upside. VIX bearish FAMs getting closer to the upper boundary probable range, about 8% upside, 18% downside. NASDAQ 100 bullish FAMs, I got about 2% downside, 5% upside. Russell 2000 bullish FAMs, got about 3% downside, 4% upside. Bitcoin bearish FAMs, but practically oversold, only got 1% of downside versus 15% of upside. Ethereum bearish FAMs, 10% downside, 14% downside, so more of a fair fight there. Shanghai Composite neutral VAMs, about 3% downside, 2% upside. WTI crude oil neutral VAMs. What a relentless move to the downside. Then if and when this thing stops going down, we are going to seriously have problems with respect to broader asset markets, because again, this is one of the factors that has contributed to the easing of financial conditions and both and easing in economic conditions as well. If you look at the consumer spending data we got this week, but anyway, 7% downside versus 12% upside. And then lastly, agricultural bearish FAMs, minus 4%, roughly 5% downside, 3% upside. Industrial metals bearish FAMs bouncing off the upper boundary of its probable range with 6% downside and 3% upside. So with that, Darius Dale presenting our macro minute for Friday, August 19th. Best of luck out there today, and everyone have a wonderful weekend. And by the way, I'm offline on Monday and Tuesday of next week, so I'll catch back here on this particular program on Wednesday. And for 42 macro subscribers, I'll catch you for the Around the Horn tomorrow on Saturday. Cheers.